Hi, everybody. Welcome to a new investment update with Lewisburg Investments. I have with me Daniel Robichaud, who is portfolio manager with our U.S. and international mandates. How's it going today, Dan?
Great.
Good. So, listen, a lot of news coming to clients right now. I believe a lot of people are taking interest in investment markets and their own investments more than in recent years with all the headlines. Can you kind of take a few minutes to explain what we're seeing and how that might impact our investments here at Lewisburg?
Yes, you're right. It's been quite a volatile period, very painful period for investors.
Sure.
This quarter. Specifically, I'd say even more for the conservative investors, which are used to more stable portfolio, but with
Right.
bonds under pressure with interest rate, seems like there was really a little space to hide in this environment.
Yeah.
So really this quarter, all the focus was on inflation. I think everyone's been hearing a lot about it recently.
Still?
And
Yeah,
the highlight
sure.
this quarter was really kind of the disruption we've seen in Ukraine with the war and a heavy wave of lockdowns in China because of new COVID case there.
Sure.
Has really fueled what was already persistent and high inflation. And that really fueled kind of a further upward move in interest rate, impacting negatively the bond because we know they're negatively correlated
That's right.
with interest rate,
Yeah.
but also impacting equities just because higher interest rate means higher discount rate
Yeah.
for equities, and that implies lower valuation. So
Yeah.
that's been affecting really all asset class.
Essentially, the market's pricing that in, right? This inflation. Yeah.
And one of the other factors now is borrowing costs for consumers is increasing. We know that energy costs or fuel price and food price has been under pressure too. So a lot of
Sure.
inflation in those two areas, and that's biting into consumers' wallet right now. And the economy is really dependent on or highly correlated with consumer spending.
Sure.
And because of those pressure, investors now are fearful of we might be heading into kind of a broader recession.
Right.
And if we're heading in that direction, that also likely means lower corporate profits.
Yeah, exactly. We're getting it from both ends: less sales and higher costs.
Yeah,
right.
exactly.
Okay.
Now, if we look at each market, in the first quarter, Canada has been really resilient, but this time, all region has been under pressure, and that's really a factor that Canada has benefited from the higher commodity price,
Right.
Given the supply constraint. But now investors are starting to be fearful that the recession might impact the demand side.
Right.
And that, so we've seen kind of commodities come off from their high. In the US, we highlighted it a few times in the past. It's a market that's a lot more exposed to technology, internet companies, and they tend to be more sensitive to interest rates. So as interest rate continued to rise through Q2, those companies has been under pressure.
Sure.
And finally, in international markets, the situation in Europe remains really tense. There's a lot of question about energy security.
Yeah.
Talks that Russia could cut all their supply of gas to Europe. And you got countries like Germany that consumes a lot of natural gas for their economy, so industrial production. And that's already kind of in the first level of alert, trying to rationalize consumption to make sure that as they head into the winter that they don't struggle with the supply of gas. So it's been overall tough markets through all regions,
Yeah.
all down low double digit.
Yeah. So, I mean, so it's been a bit difficult period, but so how has that impacted our investment strategies? Has it changed how we do things? How have we fared through this?
Yeah, so in general, it's been a tough period for the markets, but we have been doing relatively well in this environment. And I think to explain what's been happening is maybe take a little step back of what we've seen over the last couple of years. So even if last couple of years we've done relatively well, it's not been a good environment for investment style or philosophy overall. So what we've seen is government facing the pandemic starting to have a lot of stimulus. We've seen loose monetary policies to stimulate the economy, and that's led to record years of fundraising for both on terms of global IPOs, but also private assets through venture funding. So a lot of money has been raised through that period. And given the low cost of money, you've seen a lot of that money trying to chase risk, trying to make return, and investors really rewarding growth. And you could almost say kind of growth at all costs, where there was no focus on profitability or return. It was a lot of investors rewarding for growth.
Yeah, and less so value. Yeah,
exactly. And so that's kind of the first phase we've seen. And really, with the pandemic hitting, we've seen kind of two buckets of some companies getting hurt from it and other companies getting generally benefiting from this. And those companies have been rewarded really nicely. A lot of them more than doubled during that environment. And another thing that's worth pointing out is it was interesting where investors used to look at companies on earnings. Last few years, we were looking at companies based on their revenue or valuing those on revenue. And during the pandemic, we were now looking at companies on total addressable market. And so really, investors were incentivizing those companies to really just focus on growth and giving those big targets. That creates some dislocation. We felt that at that time, we were just getting hurt by this focus just on growth and not thinking about profitability.
In relative terms, anyway.
Yeah,
for sure.
So now, if we take a step back now, financial conditions have tightened quite a bit, and the economy has been reopening. So a lot of those companies that won from the pandemic, we're seeing kind of those gains kind of unwind or return to normal growth. And it's been quite a steep correction. So a lot of those companies, which were initially everyone was assuming the growth would be perpetual, now is assuming that slowdown is perpetual.
Netflix being a great example.
Exactly,
right? Yeah, okay, sure.
So we've seen that correction happening, and it's been that for good companies, but also bad companies. So it's not rare to find companies currently down more than 90, 95% from their high. So it's been a very steep correction. Now, if we look at ourselves, we've been very disciplined. We talk a lot about our investment style, and really we're just focused on finding kind of the good companies, good business. We want to be long-term holders, and we know it's important to have it at the right price also. And that's where we focused on over the last few years. We stayed away from speculating, chasing kind of the new flavor of the day. And now we're finally kind of reaping the benefit of this as kind of market has become more rational about valuations.
Right. So we talk a lot about investment discipline. I know it's a big piece of what you guys do. Do financial conditions change our strategies or modify the discipline or the flexibility of our discipline in any way? How does that impact how you guys do what you do?
That's a good question. It's kind of easy to answer in the sense that our investment philosophy didn't change, but in this market, it tends to bring new opportunities. So a lot, like I said, there was a lot of good businesses that benefited from the pandemic, but we couldn't rationalize how the market was kind of assuming perpetual benefit. And now today, what we're seeing is a lot of those companies getting punished really hard, and that's bringing new opportunities for us. So one example, this quarter, we initiated a position in Amazon, and really now it's down more than 40% from its high, and we find that we're getting this opportunity to buy one of the major disruptor of two massive industries. So retail with e-commerce, but also cloud computing at a pretty attractive valuation, just given the market got short-term concern about kind of a reversal of the benefit from COVID on their e-commerce platform.
Yes, totally. Yeah.
So that's one example. And the other example is the alternative asset managers. So both our US fund and international fund, we were able to buy KKR and Partners Group. And right now it's concerns about the fundraising environment as kind of conditions are tougher right now. But we don't see any change in the structural trend for alternative asset managers. We think alternative assets are likely to keep gaining allocation into IPS,
Sure.
and the long-term future still looks bright, but right now they're on sale just because of those concerns around fundraising and
That's right.
allocation to private assets.
Right. Well, thank you very much for that insight, Dan. It's much appreciated. Hopefully you guys were able to learn a few things. Till next time. Cheers.